If you are an investor with short term financial goals, you are advised to invest in debt funds. Does this mean investing in debt funds provide higher and guaranteed returns to investors? To gain more insights on this, we have our investment expert Mr. Gurraj with us. Gurraj, help us understand the nature of debt funds and how it works.
You can see so many categories are there, right? I'll make it very simple for you. What you should do is there will be always what is called as this average maturity in each of these debt funds. So you need to check with your advisor what is the average maturity. Why I'm saying this is, for example, if you say I'm coming for only 1 month, then you should invest only in liquid fund. If you say I'm coming for 6 months, maybe the low duration fund is what you should look at it. So that is where your time horizon and the scheme's average maturity should match. That is how you select a debt fund. That is how you select a debt fund, right? So if you are coming for 3 years, then I will probably look at something like a corporate bond fund or a banking and PSU fund, where the average maturity will be anywhere between 2.5 to 3 years. Second, very important point, people understand in equity there will be losses. Similarly, in debt fund also there will be negative return for some time. You need to understand this. Please don't think that if I invest in a debt fund, just like buying my bank FD, my capital will be always safe and I will get some return more than bank FD. Because the answer is no. Your capital will not be safe, it will be volatile. That is what I am saying. Now, you might ask this question, if it is volatile, if you say it is not safe, why should I come and invest in debt fund? Logical question, right? Now, for that only I will answer. What happens here is, why I am saying volatile is because when interest rate goes up, your bond investments value comes down. I'll just explain with a small example so that you understand this better. What happens is, I buy a bond for 100 rupees at, let's say, 7% interest. Tomorrow somebody, or rather the government itself, increases the interest rate. They say, boss, now I'll offer you 8%. The new guy who is investing will go and buy that 8% bond because he's getting for the same 100 rupees 8%. So nobody will come and buy my bond at 100 rupees because my bond is only giving 7%. So I have to sell at less than 100. This is what happens when interest rate goes up. Your price will go down. That is why my debt funds will be negative, which doesn't happen in bank FDs. Bank FDs, there is no such calculation, right? But unfortunately, all the NPAs are being covered and it is borne by somebody else, so you don't feel that loss. Whereas here, I have to account for everything. That's where my NAV will be volatile. But if you come for that particular period, you will see that despite all this happening, you will still get back your money and a decent return. See, for example, if you come for 3 years or 5 years, there will be debt funds will be safe because I'm looking at an alternative to debt funds. Today, there is a separate category called as target maturity. You know also how much you will get. So those categories are not risky. Here also you can choose which are the categories which is safe. For example, liquid fund, there is not much of a risk. If you look at all the short-term maturity fund, there is not much of a risk. So you can choose according to what is your risk appetite. Yeah. So sit with your advisor, ask this question, Buzz, what is the risk? There are two risks in a debt fund. One is, I explained, interest rate risk. Second is what is called as default risk or credit risk. Sometimes some papers might default in payment, right? It will take some time to recover. So immediately it will reflect in your NAV. So if you don't want those kind of risks, then you should select a portfolio which is having AAA bonds. So all that knowledge will be provided by your advisor. But for you, you need to understand, boss, yes, there is risk. Sit with your advisor, ask him to explain what is the risk in debt funds. How do I mitigate that risk? How can I choose a fund which is less risky? So if you ask me, one simple thing as an investor, what you should remember is whatever is my time horizon, I will match that with my average maturity. And I will understand from my advisor how is the interest rate risk in this fund? Is it high or low? How is the credit risk for this fund? High or low? That's all. These are the 3, 4 questions I will ask my advisor when I'm investing in a debt fund, right? So if the interest rate risk, if he says high, you may not prefer it. If he says credit risk is very high, you should not prefer it. That's all. Get the answer from the advisor, you decide. Interest rate risk should be low, credit risk should be low, then you will, money is safe, right? You can choose such funds. People think that when debt funds have given negative returns, there could be a loss and all that. But if you choose the right category, I'm still confident you'll be able to keep your capital safe when you come for a particular time horizon. Yeah. So this is the other categories, as I said, corporate bonds. Then instead of you buying a corporate bond, come through us. It is much better. You have better liquidity. See, for example, if I go and buy a particular corporate bond, let's say it is a 5-year corporate bond, I will not be able to take the money out before 5 years. You might say the coupon is attractive. And the problem is there is no liquidity. Whereas in mutual funds, one day you will get the money back, right? You want to invest in this government security bonds, we have fund, I mean, schemes which will invest in that. So everything is possible. Ask those three questions. Tell him what is your time horizon. Understand what is the interest rate risk in that fund which you are choosing. Understand what is the credit risk in this fund. Just ask these three questions, because I'm sure advisor will give you the right debt fund. The more pertinent question is why I'm investing in a debt fund. Answer is very simple. I don't want to take risk. I have enough investment in equity. This is something where I want my capital to be safe.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.